Ross O'Brien with the Economist Corporate Network in Hong Kong. We've just wrapped up our semi-annual regional strategic forecast with my guest Leo Abruzzese, who's the Global Forecasting Director for the Economist Intelligence Unit based in New York. Leo, I wanted to kind of wrap up this morning's session by getting you to talk again about your baseline scenario for Europe in 2013 and 2014. Is the eurozone going to collapse in a ball of fire?
There's a significant chance of it happening, but the simple answer is no. We do not think it will collapse in a ball of fire. A couple of reasons for that. One is, as uncertain as the political environment has been, Germany on one side, most of the peripheral countries on the other, we see some evidence. Slow, halting, it will take a long time, but there is some political progress being made. As recently as now, in early September, we may see strong steps from the European Central Bank, possibly providing a floor or some underpinning for some of the countries. None of this means the crisis is over. It won't be over for years. But considering the sort of now infamous Lehman Brothers scenario, and will something like that happen, it seems a bit less likely than it was before. And if it did happen, by the way, if it did happen, we've said before, we'll say it again, it will make Lehman Brothers look like a picnic. Because if those countries do collapse, the repercussions would be so severe that it would hit the US and Europe and Asia far worse than Lehman Brothers.
You told me in the meeting this morning that the cost, primarily borne by Germany, but by Europe as a whole, the cost of continuing to muddle through with various bailouts and other financial provisions would be far less than the cost to Europe's economy should the euro collapse. Now, can you kind of quantify those two scenarios? What's it going to cost Angela Merkel up front versus how much might it cost Germany and the rest of Europe should things blow up?
It's difficult to put exact numbers on them, but certainly if it winds up costing Germany a few hundred billion euros, it won't even cost them that much over some period of time. It's a lot of money. You can understand why German taxpayers don't want to do that.
Right.
But if we're talking also about the losses to German banks and also the economic losses to Germany. Remember, Germany is an economy that under normal circumstances, especially as strong as it is fundamentally, should be growing by 2.5%.
Yeah.
If the eurozone breaks up, the eurozone will likely contract by 7 to 10%, and Germany itself will probably contract by 2 or 3 or 4%. So for an economy of that size, we're talking about an enormous loss of income, an enormous loss of economic momentum. At the end of the day, considering also the unexpected, the unknown consequences as well too, it is a deal for Germany to stump up what they need to put up right now,
Right.
with appropriate conditions to make sure they are not throwing good money after that.
Moving across the Atlantic, you actually were uncharacteristically optimistic about the U.S. I mean, you've signaled that it's going to be a long road ahead, but you gave a potential scenario that spoke to the U.S.'s potential ability to come back very strongly, and in fact be the, as you put it, the comeback kid.
Not probably within 5 years, but I would suggest that if you're looking towards the end of this decade, I think there's a significant possibility that a number of things will break well for the U.S. For the next year or two, the U.S. will do well to grow by 2%. Nothing
Right.
exciting. We still have those traditional problems we've had for the last few years: housing, banks, lack of jobs, consumer uncertainty. But look ahead a bit. What do you see when you look ahead? You see that the deleveraging, an awful word for paying down debt, the paying down debt process in the U.S. is moving ahead quite a bit faster than most people expected. That's a positive, because once the debt comes down, the consumers are back in the game. You're seeing the U.S. potentially, and it's already happening, enjoying an energy bonanza.
Yeah.
The U.S. over the course of many years pays trillions of dollars in deficits on its current account, a lot of that money going to oil and energy producers. To the extent that the U.S. now has new sources of energy, and it does, and it can keep some of that money at home and potentially invest it, that's a good sign. And even though U.S. workers, as President Obama says, haven't had a raise in a long time, which is unfortunate, it has had the perhaps unintended consequence of making the U.S. more competitive globally in labor markets.
Right.
So if you look at energy, you look at labor market competitiveness, you look at consumers paying off debt, and you have a time frame of 5 to 10 years, I would say that there is perhaps a bit more upside potential than the doomsayers would normally suggest.
Okay. Finally, Leo, the recurring theme in your talk this morning stressed how significant and primary the political sphere is in our current economic problems. Just tell me again just how significant, and I suppose how important is politics in this day and age to, or let me phrase it another way, will politics, or better politics, get us out of this economic malaise?
Well, certainly bad politics has helped to get us into this and to prolong this. These economic problems are there. The debt is there. The debt is not a political issue. People spent more than they were bringing in.
Right.
But nonetheless, the fact that some of these problems have continued as long as they have, and that they have gotten as bad as they have been largely political. So in Europe, there is a debt problem, but this has lasted for 3 years because political leaders have been unable to agree.
Right.
So the European issue is a debt problem that has been exacerbated to the nth degree by politics. In the U.S. certainly has jobs problems, but the U.S. goes through every 6 months an embarrassing, incredible fiscal mess that causes companies and consumers to lose confidence, and the U.S. grows less than it would otherwise, largely because of fiscal and political ineptitude. We've had similar situations in Japan. The politics in Japan have been weak. Yeah. And less so in China, but even now in China, political decisions, the size of the stimulus will determine how much China grows or does not grow over the next year.
Right.
So there are economic issues, but in all cases, the politics have generally not been handled well, and relying on the politicians does not perhaps give one a great deal of confidence that the economies will have the strength that they should have.
Right. Well, on that measured but perhaps not entirely rosy note, thank you, Leo, for joining us today, and thanks for your outlook.
Thank you, Ross. I appreciate being here.
All right. I'm Ross O'Brien with the Economist Corporate Network in Hong Kong. Thanks for watching.